I'm Kenton, and this is Kenton Knows. In this video, I'm going to explain how you can build your wealth with a residential real estate investment. First, I will explain the various ways to build wealth with real estate, and then I will provide real numbers from a multifamily property I bought in 2012 and still own today. My numbers will be straight off my tax returns to show you the cumulative return of each way this property has increased my wealth. If you like this video, please hit the like button, leave me a comment, and consider subscribing to my channel. To begin, the United States tax code is fairly generous when it comes to real estate owners, so I will be getting into taxes as well as refinancing, management, and maintenance, as well as rental growth and property value increases. The example I will be using is a residential property I own in Chicago, which has had growth in both rents and market value, but there is no guarantee that the property you purchase will achieve the same results, as there are a lot of factors that go into real estate. And on the flip side, your property may experience faster growth than my property, as Chicago is, in my opinion, a slow and steady market with small but continual increases. I want to also point out that in real estate, I believe the most important part of any transaction is the purchase. If you overpay for a property, it better be in a super high growth area, or you will have a very hard time making up for overpaying. For the most part, you will not be so much better at renovating or managing a property that you can significantly make up for overpaying. I will start by listing the various ways real estate builds your wealth, and then I'll explain each one in detail. 1. Property appreciation. 2. Rental income. 3. Loan principal paydown. 4. Depreciation. 5. Mortgage interest deduction. 6. Property taxes and other deductions. 7. Cash out refinancing. 8. Renovation or capital improvements. Starting with the most obvious way to build wealth is property appreciation. In general, real estate will appreciate in value at about 0.3% more than inflation per the Case-Shiller data going back over 100 years. Of course, some areas of the country will appreciate more or less depending on the demand, which is basically driven by population growth in the area, since the type of real estate I'm talking about is residential housing. Yes, we can get into more detail, but that really isn't the point of this video, so I'll leave that for another discussion. Since this is a residential rental property, the owner will also receive monthly rental income from the property. I am assuming that the rents actually cover all of the property maintenance, mortgage, taxes, utilities, and any other costs associated with owning this property, so there is a net positive rental income. The owner also experiences some principal paydown of the loan each month, which increases the owner's equity each month. Or said another way, the owner's wealth continues to increase by the difference between the market value of the property and the outstanding loan balance. The next 4 are non-cash deductions, which simply reduce the owner's taxable income each year. The first one is depreciation. For residential real estate, depreciation is calculated on the building only, and many accountants will use 90% of the purchase price for the building depreciation calculations. Land cannot be depreciated. So if you buy a property for $100,000, the depreciable amount would be $90,000. You then take the $90,000 and divide it by 27.5 years to determine the amount you can depreciate each year, or in the case of this fictitious example, $3,273 per year. If you make improvements or buy new appliances, they may be depreciated over a different time frame. Next is the mortgage interest and property tax deductions. This is where you can deduct the interest on the loan and the property taxes paid each year. Here is a list of other tax deductions you may want to also take advantage of each year. Insurance, both landlord and an umbrella policy if you have one. Legal fees if you use an attorney to perhaps reduce your property taxes, create an LLC, evict a tenant, or edit your lease. Professional fees if you use an accountant or other professional. Management fees if you pay a property manager. Commissions if you use an agent to lease your property. Repairs and maintenance, as well as property supplies such as furnace filters or light bulbs. Utilities such as garbage, water, and electricity. Cleaning between tenants and or for the common areas. Mileage to and from the property or to the stores to pick up materials or supplies for the property. Meals if you need to eat while working at the property or before or after to discuss the property leasing, future repairs, or any other similar legitimate business discussions during a meal. Credit and background checks for new tenants, office supplies, and perhaps a deduction for your home office. Any refinancing or bank fees associated with the property. One of the greatest ways to add to your wealth with real estate is cash out refinancing. When you refinance a property and take cash out, the cash is not taxed. This is huge. Your tenants pay down the loan, and you can take out that equity without being taxed. Then, a few years later, after they pay it down more, you can do it again and redeploy that cash into other properties or investments completely tax-free. Renovations and capital improvements are another way to grow your wealth. Normally, these improvements will increase the value of the property as well as increase rents, in addition to increasing your tax deductions, which decreases your taxable income each year. Personally, I like to do the major renovations right after I buy the property, and then the maintenance and upkeep is less disruptive to the tenants in the future. So now that I've explained the various ways real estate can create wealth, let's look at an actual property I purchased in 2012, completely renovated, and I still own it today. I'm going to show you how much each of these components added to my wealth over the years. For simplicity, I will not address the time value of money or the opportunity cost of the money invested or the income generated. Both are relevant, but it would really complicate this video and take away from the simple message I'm trying to convey. The property I'm going to be talking about is 334951 North Lawndale. The building has 4 units, each with 2 bedrooms and 1 bath in the Avondale neighborhood of Chicago. The building was vacant when I bought it, and I did a complete renovation of the property after purchasing it. So let's get into the numbers. I'll explain what happened each year and then summarize the net of each year with a grand total summary at the end. Since many of these items occur at different times throughout the year, you can't redo the calculations yourself and arrive at exactly the same numbers, as I'm pulling the numbers straight off my tax return, which were calculated based on the exact dates each event happened during the year. I closed on the property on March 9th, 2012 for $220,000 and immediately started the renovation. I spent $178,937 on the renovation plus $5,574 on appliances. I received a total of $28,818 in rents, paid $11,668 in interest, claimed $12,304 in depreciation, and another $11,585 in other deductions. So I had a tax loss of $6,739, which actually offset income from my other properties. But for this example, I'll carry it forward for the next year. I refinanced the property in October of 2012 and paid $4,085 in refinancing charges. The property appraised at $480,000, and I was able to get a loan of $312,500 on the property. So in summary, here are the numbers for 2012. Invested a total of $404,511, and the property is valued at $480,000, which equals $75,489 in property appreciation. Also note, I do still have $92,011 of my own money in the property, as the loan is only for $312,500. $28,818 in rents minus $23,253 in expenses equals a net income of $5,565, but due to depreciation, I won't pay any taxes on that income as the deductions are greater than the income. So there's actually a tax loss of $6,739. There is some loan paydown, but I'll skip that as the future refinances will cash out the paydown and I don't want to count it twice. For 2013, I received rents of $66,230 minus $27,672 in expenses, which equals a net income of $38,558, but due to the $14,279 in depreciation, I will only be taxed on a net income of $24,279, and if you use the carry forward loss of $6,739 from last year, it is really only a taxable income of $17,540. For 2014, I received rents of $67,315 minus $26,746 in expenses, which equals a net income of $40,569, but due to $13,953 in depreciation, I will only be taxed on a net taxable income of $26,616. To avoid this repetition, I'll populate a table with the rents, deductions, and net income each year, but I will highlight the refinances as those are much more interesting. In November of 2015, I refinanced the property and it appraised at $500,000, which I thought was not a fair appraisal, but due to the lower rate, I moved forward with the refinance. The new loan amount was $350,000 and I received $47,629 at closing. The first loan after renovations was $312,500 in October 2012, so some of the cash out on this refinance was for paying down the original loan, and the other part of it was from the property appreciating. Rents continued increasing, and I refinanced the property again in 2016. This time, I got a much better appraisal of $660,000, which is a little crazy that the value increased $160,000 in 11 months, but I only did a rate and term refinance, so the new loan was $353,000. In March of 2020, I refinanced it again, and the appraised value was $725,000. So the new loan was $507,500, and I received $162,243 at closing. I haven't finished out the year yet, or even looked at starting my taxes, so I just increased the rent and expenses a little, and left depreciation the same compared to 2020, so I can have final numbers for the year. Now, we are at the end of 2021. Let's look at the total cumulative numbers by year and the wealth that this property has made for me over the years. To summarize, the value of the property has steadily increased over the years to about $735,000, and I have an equity position in the property valued at $242,000. In 2012, I had $92,000 invested in the property, and as of 2021, I have paid that back and taken out an additional $117,861 from the property tax-free. Let me just restate that. I have absolutely no money invested in this property anymore. I have taken out my initial investment plus an additional $117,861, yet I still have a substantial equity position, and the property is making me money every year. Over the years, I have collected a total of $654,755 in rent and paid expenses of $312,271, which means that I have received a total net income of $342,484 in rents after expenses for the property. I have taken a total of $135,957 in depreciation and have a total taxable income from this property of $206,527. So, I have increased my wealth by $702,861 from just this property in just under 10 years. Of that $702,861, only $206,527 was taxable, so nearly $500,000 was not taxable. I've also locked in my current loan for 30 years at 3.5%, so I can expect to maintain a decent income each year going forward from this property while the loan continues to be paid down and the property continues appreciating in value. That's the power of real estate investing. This was a real-world example taken straight from my personal tax returns on how you can grow your wealth in real estate. This property didn't double in value, and rent didn't go through the roof, but they both grew steadily over the years, and the tax code is also fairly generous to real estate investors. Real estate may not make you rich overnight, but you should see slow and steady growth in your wealth over the years, which I find incredibly rewarding. I hope you enjoyed taking a look at the financial history of this property with me. If you liked this video, please hit the like button and consider subscribing. If you have any questions, please leave them below. If you really liked it, please share the video with someone who also might enjoy seeing it. Thank you for watching Kenton Knows, and I wish you the best of luck with all of your real estate investments.